You've probably spent weeks, like I have, trying out 1,000 different indicators on TradingView, watching indicator videos on YouTube. Maybe you went down the smart money concepts rabbit hole and spent hours learning about fair value gaps. Even after all of this, still the price action leaves you perplexed. Why the hell is it pumping? My oscillator is flashing red. Then that oscillator repaints and leaves you stopped out. Been there, done that, trust me, many times. I gave this up a long time ago. I stopped short-term trading and started long-term cycle investing. That has changed my life and also has let me sleep at night. I began focusing on what really moves Bitcoin: macroeconomic data, things like the ISM, CPI, Fed rates, M2, the dollar. So today we're going to dive into how the dollar specifically affects Bitcoin movements and how you can use it to enhance your returns. Every major Bitcoin move, it echoes something the dollar just did. So let's get into the actual data. The first thing is I'm going to share a chart of Bitcoin returns after a 3 standard deviation negative move in the dollar. So let's pull it up here. This is what it looks like. For this, I used Python with Yahoo Finance and Pandas to pull up all the data. If you're interested in this, I will leave a link in the description. So you can see after a 2-week negative standard 3 deviation drop in the DXY, Bitcoin on average, regardless of sort of where it ends up, it always ends up higher 12 months later. So the DXY is slightly lagging, and I'll show that in the next chart after this, but I wanted to just take a step back and talk about a little bit about how the dollar index actually works. So the DXY specifically measures the dollar strength against a basket of major currencies, things like the euro, the yen, the pound, and others. But it's not just a currency index, right? It's a global risk barometer. When investors get nervous, they sell risk and run to dollars. More demand for dollars means that the DXY rises, and thus liquidity itself tightens. A strong dollar increases borrowing costs. It pulls capital out of emerging markets and basically forces global deleveraging. Most assets in the world and most debt in the world in other countries is generally priced against the dollar. In that kind of environment where the dollar is increasing, speculative assets, especially Bitcoin, they bleed. So let's talk about why Bitcoin cares. Bitcoin isn't isolated. It is macro sensitive. It is a global asset, definitely correlated. So I'm going to pull up TradingView here really quick. This is showing the DXY against Bitcoin, but it's inverted. So this is actually the dollar falling here, but it's inverted because it shows the correlation a little bit easier. And I will show you in a second how to actually set this up yourself so you can track yourself. This is the weekly Bitcoin chart in the background, and the dollar is overlaid in green. So in 2020, the DXY fell after massive COVID stimulus. You can see that kind of starting right here where we had the COVID drop, and then it just fell. Liquidity flooded the system and Bitcoin went vertical. So in 2022, 2021, the Fed hiked rates, right, to fight inflation. DXY hit basically a 20-year high. You can see that here. And Bitcoin crashed basically over 75%. It's definitely correlated. You can see where we are at now, where at the beginning of the year, basically January 1st, the dollar started weakening and we've had a subsequent rally, although we've had, some volatility as is per normal with Bitcoin. This is the pattern. DXY up, that means tightening liquidity, higher global stress. DXY down means looser conditions and capital flows into risky assets, aka Bitcoin. Bitcoin basically runs on excess liquidity, and DXY is one of the best forward-looking indicators for this. If you ignore it, you're flying blind. I will actually show you how to set this up yourself. I have a fresh BTC chart on a weekly time frame. So this is on TradingView. You can't actually see it, but right above where this Bitcoin is, you can actually input what symbol you're looking at. There's a little plus next to there. That'll allow you to compare the symbol. So you're going to compare the symbol. You're going to do DXY, and you're going to click new price scale. What you want to do next, this is the price scale for the dollar. As you can see here, I'm moving it around as I want to. You're going to right click and you're going to hit invert scale. And that's basically going to match up. This is what you see here on my original chart. It's about confirming your macro environment. You don't really want to be going long Bitcoin when the dollar is strengthening. When the dollar is weakening, that's a good spot to actually be going long. And it's not just Bitcoin, it's any risk assets. All in all, I hope hope this video helped you. Just remember that Bitcoin is a volatility sponge for global liquidity. The US dollar is basically the tap. So if you're serious about this market, respect the dollar, because when it breaks down, Bitcoin breaks out. Hope you enjoyed this video. We'll see you again next time. Thank you for watching.